All right, everybody. I'm going to go ahead and start the 1031 exchange presentation today. Kristen has mentioned that we have more seasoned real estate agents with us today. So I may, go over the 1031 exchange um, information, some of the more commonly available ones a little faster. But I'm going to talk about some more advanced concepts as well. So let us get started. Hi everybody, my name is Wei Ming and I am with Asset Preservation Inc. We are a 1031 exchange company and the only thing we do are 1031 exchanges. So we're not escrow, we're not real estate agents, and we are not tax advisors or CPAs. And this is our disclaimer. The information I give you here today will be more general information to help you and help your clients when making that decision whether or not a 1031 exchange is a good fit for you. Now, before we dive into 1031 exchanges, there are a number of things that I want everybody to understand. There are a number of topics we will be discussing as well. Some of the more commonly asked questions like extensions, what are the types of exchanges, and as more seasoned investors, I'm going to talk about some of the things that you encounter as a real estate agent, such as clients who may be living in the property right now. I have a lot of clients who will ask, "Hey, can I do an exchange? Is there any way I can do an exchange?" There are ways that you can do it depending on how you structure how the property is used. I'll talk about that. But diving straight into the 1031 exchange, let's go over that right now. The 1031 exchange, section 1031 of the Internal Revenue Code says no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind which is to be held either for productive use in a trade or business or for investment. What this sums up to is, ladies and gentlemen, is that if your client is using the property for business, investment, or trade use, they just have to buy another property that they're going to use those things for in order to qualify for a 1031 exchange. For most of my clients, they are renting out their property. If they sell an investment property like that in the United States, they simply have to buy another one in the United States. And it can be any type of investment real estate. It can be land, it can be commercial, it can be residential, multifamily, whatever type of real estate that you want. Now, today, let's talk about the topics. We will talk about the 1031 exchange changes, any extensions, the type of exchanges clients can use, and I'm going to talk about split treatment. Split treatment is, just for everybody to get an idea, is when a client is using a part of the property as their primary residence and a part of their property for investment purposes. They can take advantage of both the 121, the homeowner's exclusion, and the 1031 exchange at the same time. I'll talk about how that can be done in a little bit later on in my slides. Now let's talk about changes. I understand that there are usually a lot of talks about changes to 1031 exchanges. And to be honest with you, for the last few administrations, a lot of those presidents have mentioned making changes to 1031s or eliminating 1031 exchanges. The last real big change to a 1031 exchange was back in 2019. Personal properties were no longer exchangeable. Things like classic cars, paintings, airplanes, Livestock, those used to be exchangeable, no longer the case. The only thing exchangeable now are real properties. So only real properties, so only real estate. Now, the current talk in the Senate and excuse me, the only talks in Senate and the president's having are what should we do with 1031 exchanges? Everything's sort of divided right now. There are some that are looking to keep 1031 exchange as is, but President Biden is looking to eliminate it. Are 1031 exchanges going to get eliminated? Most likely not. There has been numerous studies, and you can let your clients know. There have been numerous studies where 1031 exchanges may be able to provide the Treasury with a certain amount of tax revenue every year, but the result of taking 1031 exchanges ends up with losses in the real estate industry that more than doubles what the 1031 exchange tax revenue would have gotten the Treasury Department. So those studies back that by taking away 1031 exchanges, it does more harm than good. Now, that's all being in talks right now. Or again, are we expecting it to pass? Most likely not. There could potentially be other changes, but it is simply a proposed bill or proposed budget. Now, let's talk about extensions. This has been happening quite a lot. Due to the recent rainstorms in California, we've had a lot of natural disaster declarations by the IRS. Now, a lot of clients will often ask me, Wei Ming, can I get an extension to my 1031 exchange? And the answer is no. Nobody can pay for extensions. Nobody can grant extensions except the IRS. They are the only ones who are able to do so via a natural disaster declaration. And by doing so, they will always post this on their website. The affected taxpayers who, with the affected disaster areas will get an extension. How long? The IRS will always post it on their website. Now, as you can see, I have added quite a number of extra counties since the last time I did a 1031 exchange presentation for Legend Realty, and they have included almost double that, double the number of counties. Again, you can always check this on the IRS website, but it basically says those taxpayers who are in these counties, who are doing business in these counties, doing their exchange in these counties, if you are affected by the natural disaster, your day 45, if you're approaching your day 45, it can be extended to May 15th. If you are approaching your day 180, your day 180 can be extended to April 15th. So the best course of action, if you think you're an affected taxpayer, ask your CPA or tax advisor. They will let you know if you qualify for this. We, the exchange company, will not tell you if you are qualified for this because we don't know how these disasters affect you or your business. So talk to your CPA or tax advisor and ask them if you are considered an affected taxpayer. Now, ladies and gentlemen, one of the most complicated aspects about a 1031 exchange isn't actually executing the 1031 exchange itself. It's about how title is held, both for the relinquished property and the replacement property. There are a number of options available, and I'm going to quickly kind of go over this. If you want a copy of these slides, I will provide a copy to Kristen so that you can use these slides. Without further ado, let's talk about individual taxpayer. let's look at John's scenario. He owns a property and he's going to sell it as an individual. Now, when he sells it as an individual, he is a single taxpayer. He can either purchase a replacement property in his name, his own LLC, or his own trust. Now, LLCs and trusts can be disregarded if it's a single member LLC or a single member trust, like a living trust, or with an individual and their spouse. When the individual is in that entity with another party, like, for example, John's brother, in an LLC or a trust, that property is considered regarded. John and his brother are not married to each other, so that LLC and trust cannot be disregarded. So what I'm trying to say is, ladies and gentlemen, that title can be very complex in a 1031 exchange. You may be selling as an individual, but you may be buying as two taxpayers. You could be buying with your brother, with other family members, or any other third party. Please, please, please consult your tax advisor or your 1031 exchange QI and ask them what are the available options. And as you can see, there are numerous options available to you. I could literally spend a whole hour going over this single slide on the different variations of each corporation or each entity. But just to give you an idea, you do have options, and this can be complicated. So please talk to us before selling that property so we can properly advise you. Now, ladies and gentlemen, one of the most commonly asked questions I get on a weekly basis is, Wei Ming, how much capital gains taxes do I owe? And my answer to my clients are typically, I have no idea. I actually do not know, but I can give you a rough idea on what it might be. If you want the precise numbers, please talk to your CPA. They can always calculate that number for you. When clients talk about capital gains taxes, they think it's typically just one number. Actually, it's comprised of four different things. We have federal taxes, state taxes, depreciation recapture, and net investment income tax. A blended average of all four things, and you may be looking at anywhere between 30 to 33%, especially if you're selling in the state of California. Now, ladies and gentlemen, I have seen this range go from anywhere about 25% all the way up to 39%. So this can be a huge range. Talk to your CPA, get that exact number. But if you don't have one or you just want quick calculations, ballpark it anywhere from 30 to 33%. 33% is what I typically use for ballpark numbers. Now, ladies and gentlemen, let's take a look of an example of what that actually looks like, because a lot of times clients want to see examples of this. You can always provide them with examples of this, but I will give you an even better tool after I explain this. In this example, there are two things I want to find out in order for me to decide for myself whether or not a 1031 exchange is a good fit for me. Number one, I need to figure out what my basis is, roughly what that is. And with that number, I can find out roughly how much capital gains or profit I have on my property. In this example, I bought this property for $500,000. I went to my CPA and I asked him, John, how much have I depreciated my property so far? He tells me, Wei Ming, you have depreciated your property about $100,000. And I went to Jerry to sell this property. And Jerry has told me I'll need roughly about $25,000 worth of work to improve this property, get it ready for sale, and I'm going to sell and net $1 million. What do I do with these numbers? Well, ladies and gentlemen, I bought my property for $500,000, and I know that depreciation will lower this number, but capital improvements will increase that number. I have bought my property for 500. I depreciated 100,000 down to $400,000, and capital improvements bring it up to $425,000. If I sell and net this property for $1 million, well, after I subtract my adjusted basis, I will have a gains of roughly $575,000. My CPA did all the calculations for me, and I find out that I have roughly $197,000 and change in taxes if I do not do a 1031 exchange. Now, ladies and gentlemen, as I mentioned, you don't need to know all these calculation numbers. You just need to know that there are those numbers, and it can get complicated. What you can do, however, is go to our website at apiexchange.com. I do have a link here in my slides. If you click on that link, you will be brought to a calculator, and that calculator on our website will help you to calculate and give you an approximate tax bill that you'll owe the government, you owe Uncle Sam, if you did not do a 1031 exchange. On that calculator, it will ask you for things like how much you sold your property for, what your tax bracket is, what your tax bracket percentage is, and it'll calculate all of that for you and spit out a number, and that number is going to be very, very close to what you owe. It will give you an approximate number, and with that number, you can decide whether or not a 1031 exchange is a good fit for you. Oops, did not mean to press the end. Now, ladies and gentlemen, let's talk about the types of 1031 exchanges that you can use. Now, as seasoned real estate agents, I'm sure you've heard of the second type of exchange. But let me explain that there are 5 different types available to your investor. The first type is called the simultaneous exchange. It allows you to close on the property you're selling and the one you're buying on the same day. Now, that can be very complicated for a lot of investors. Trying to coordinate everything to close on the same day, that's going to be difficult. You can do it, but that will be difficult, which is why many of my clients prefer to use what's called a delayed 1031 exchange or a regular 1031 exchange, what most people are familiar with. This allows you to sell your property, have 45 days to identify, and a total of 180 days to close on your replacement property. But wait, what if you see a property that you have to have, that you must buy right now before somebody scoops it up? Inventory is getting lower again. People are going out there and starting bidding wars on replacement properties again. There is a lot more activity now, which is why I have been seeing clients utilize what's called a reverse 1031 exchange. A reverse 1031 exchange will allow your client to buy the replacement property first, and from the close of escrow, have 45 days to pick what properties they would like to sell, and a total of 180 days to close on any of those sale properties, any of the properties that they want to sell. The fourth type of exchange I'm going to talk about is the construction or improvement exchange. Ladies and gentlemen, this is my favorite one because it gives you a lot of possibilities. In this type of exchange, you can use any of the exchange funds to make any capital improvements on the property you are buying in the 1031 exchange. So it's not for you to use to pay down debt on other properties, not to pay down debt on your credit card bills or anything else. It's for you to make capital improvements on the property that you are buying in the 1031 exchange. Now, you are a real estate agent, just like Jerry. Let's say, just like Jerry, you got your client a really good deal. They were looking at this $1 million property, but you got them this property at $925,000. You have $75,000 remaining. What do? Well, you can either keep that $75,000, be done with your exchange, keep that $75,000 and pay taxes on it. You can use that $75,000 to buy other investment properties in that 1031 exchange, or you can spend that $75,000 to make those capital improvements. It can be any capital improvements that you want. Landscaping, new roof, new pool, new room, new ADU, new unit, whatever capital improvements you want. One exception: you cannot use those funds for prepaid work. The work has to be completed within the 180 days for it to count towards your 1031 exchange. Last but not least, we have the reverse construction exchange. The reverse construction exchange allows you to buy the replacement property first and start improvements on it. You still have the 180 days to make any improvements you want, and still within the 180 days to close and sell your property. Now, ladies and gentlemen, there are 4 key points to a 1031 exchange. I'll quickly go over. And as seasoned real estate agents, you may have heard of some of these. First one is property qualifications. How does my property qualify for a 1031 exchange? It simply has to be used for business, investment, or trade use. Now, a lot of people will hear you need to do so for 1 year. You need to do so for 2 years. What is the actual answer? Well, the actual answer is both works. What I mean by that is there are a lot of CPAs who will say you need to rent it out for at least a year. Some CPAs will tell you 2 years or longer is better. My answer to clients is the longer, the better. There is no specified time in the Internal Revenue Code that you have to stick by, but talk to your CPA, see what they are comfortable with. The longer that you have it, the more conservative it's going to be. The shorter the time, the more aggressive of an exchange, meaning that if you get audited, there are higher chances of you getting disqualified for your exchange and having to pay those taxes. Now, ladies and gentlemen, the second key point I want to talk about is tax deferral. How do you defer your taxes? 2 things to keep in mind. Number 1, you have to spend all the cash from the sale of your property. And number 2, purchase equal or greater to your net sales price. Now, if I sell my property for $1 million, I still have to pay my closing costs, agent commission, escrow fees, transfer tax, and recording fees. Let's say that's $100,000 from selling $1 million property. I know that's a little high, but let's just use that as an example. Now, in this example, $900,000 is my net sales price, but after paying off my loan, I will only have $400,000. I have to, again, spend all the cash and buy equal or greater to the net sales price. So spent $400,000, buy equal or greater to $900,000 or more. How I come up with the difference does not matter. Out of pocket, another loan, a combination of the two, borrow from family, does not matter. Now, the Third thing I want to talk about is the timeline. How much time do you have in your 1031 exchange? It's the same for all the types of exchanges. From the close of escrow, you have 45 days to identify and a total of 180 days to close on the replacement property. And this is a delayed exchange. Well, how do you identify? There are a number of ways you can identify. There's 3 ways. You can choose either one of the 3, but not a combination, not all 3. The first rule it's called the 3 property rule. It allows you to identify up to 3 properties of any value. The second rule is called the 200% rule. It allows you to identify as many properties as you would like, but the combined value of all these properties cannot exceed 2 times what you sell your property for. So, ladies and gentlemen, the most commonly asked questions about identification is, Wei Ming, which one do I use? For most of my clients not looking to buy more than 3 property, they typically use the first rule. For clients who are looking to buy more than 3 properties, or more bang for your buck, if you will, they often use the 200% rule. Now, if I sold my property for $1 million using the 200% rule, I know I can identify a total of $2 million. Now, if I took $2 million to states like Texas, maybe Florida, I can probably get 4, 5, maybe even 6 properties in those states. So more bang for your buck. Now, ladies and gentlemen, the last rule is called the 95% rule, hardly ever used. I have done over 2,000 exchanges for clients, and I've only seen it 3 times. Now, I typically see these in portfolio transactions. This is because the rule says you can identify as many properties as you would like, no limit to the value, but you must purchase 95% or more of the value of all the properties you identify. So I can sell a property for $1 million and pick $100 million worth of real estate, but I better buy $95 million or more, or my exchange fails. And the reason I say I typically see these in portfolio transactions is because the seller typically says you either buy everything in the portfolio or you don't. I'm not going to sell it if I break it up. Now, ladies and gentlemen, I want to talk about the split treatment here. And the reason I want to talk about this is because it's a little bit more of an advanced concept. And again, Kristen had mentioned that there are a lot of seasoned real estate agents listening today. So I want to talk about this since this is not commonly known. Now, in this example, you're going to encounter a lot of clients, or not just an example, you're going to encounter this in your career, where there are a lot of sellers who will say, well, I have taxes to pay. I'm living in my home right now. And I have been living here for a number of years. I've got quite a bit of gain, quite a bit of profit on the sale if I do sell it. But if I have taxes to pay, I don't want to pay it. All right. While your client, if they're married, they can take up to $500,000 tax free, but that's it. If it's their primary home, that's the only thing that they can take. They cannot do a 1031 exchange on a primary residence. However, you can do a 1031 exchange. You can do a 1031 exchange on any portion of a property that has been used for business, investment, or trade use. This means that it can be an office, that if your client has been using an office, reporting on their tax returns, that portion of the property will qualify for a 1031 exchange. They rent out half the property, they can do a 1031 exchange for that half. Rent out a quarter, rent out 10%, whatever they rent out, can qualify. Even that ADU that they rent out in the back, that can qualify for 1031 exchange as well. Let's take this example. Now, this person, let's say that's me. I sell this property for $1 million and my basis is $400,000. If I will have in this example $600,000. Let's say I'm married and I can take up to $500,000. Well, that's great. I'll be left with $100,000 and I'm going to have to pay taxes on it. Well, I'm going to be like one of your clients saying, well, Jerry, I understand I can take $500,000 tax free, but I still got to pay taxes on $100,000. I don't want to pay anything, so I'm not going to sell it. Wow. Okay. If you know you're going to be selling your property in the future, and you know potentially that your client may want to downsize, utilizing that property as part investment and part primary may be a good fit for them. Here's how. In this example, I'm going to rent out half the property to my brother. I'm going to rent out the bottom half to my brother, and I'm going to live on the top half of my property. And the top half is exactly the same size as the bottom half. I'm going to do so. I'm going to rent it to him for 2 years before I sell the property. So what is that going to look like? Well, here's what that's going to look like. It's 50% primary, 50% rental. If I were to sell this property for $1 million, I'm essentially selling the primary portion for $500,000 and the rental portion for $500,000. Remember, my basis was $400,000. I'm going to split this in half, 50-50. 50% for primary, 50% for rental. So basically, my primary portion's basis is only $200,000. If I sell it for $500,000, my profit in the primary portion is only $300,000. I'm married, so I can take up to $5,000. So I get to walk away with that $300,000 gains tax-free. My basis is not taxed. Now, what happens to the rental portion? Well, I just need to do a 1031 exchange for that entire $500,000 portion because I sold it for $500,000. Well, sold and had a net sales $500,000. I just need to do an exchange for $500,000. Essentially, I walked away with half of it tax-free. I have $500,000 in my pocket, and if I'm an older client, I can choose to downsize using that $500,000. And this doesn't have to be exactly 50-50. If I know I want maybe more gains on the primary portion, I could have rented out 25% of the property to my brother, taken more on the primary portion, and I can take more of my exclusion. So ladies and gentlemen, this is one of the ways that you can entice clients to potentially sell their property. If you know, hey, my client's getting older, they may want to downsize and move next to their kids, move closer to their grandkids. Well, they can do so by utilizing this strategy and also doing a 1031 exchange and get a rental property with passive income on the side. That's one way to do it. Another method to this is, well, I can potentially rent out the entire property, right? Absolutely. Instead of me living in this property, I'm going to go and move in with my kids. I'm going to convert this whole property into a 1031 exchange. When I sell this property 2 years from now, I will still qualify for the $500,000 exclusion. Why? Because the exclusion says if I have lived in the property for 2 out of the last 5 years, I still qualify to take up to $500,000 tax-free if I'm married. I've only rented out my property for 2 years, so the last 5 years will consist of 3 years of primary residence, 2 years of rental. So ladies and gentlemen, 2 methods for you to consider and help educate your clients. If they do not want to pay any taxes and possibly execute an exchange, they may be able to rent out a part of their property, or they can move out completely and rent it out and take advantage of the 1031 exchange in the future. Now, ladies and gentlemen, one of the other questions I typically get is, Wei Ming, can I live in the new property I buy in a 1031 exchange, or can I buy it with another person? The answer is yes and yes, and it depends. There are conditions how you would have to structure that. In this example, let's say I sell my property for $1 million. It's a complete rental. I sell my property for $1 million and I want to buy a property for $2 million. It's a duplex, $2 million. Can I use half the property? Absolutely. In this example, because I'm only doing a 1031 exchange for $1 million, I only need to rent out $1 million of that new property I buy. Even if I buy a property at $1.5 million, I'm going to need to rent out for $1 million. So $1 million would be that 67%. I can live in the other 33%. Now, can I buy with other people? Absolutely. But we have to be tenants in common. Can I buy with my kids? Yes, I can absolutely buy with my kids. We are eyeing a property for $1.5 million. I sold my property in a 1031 exchange for $1 million. I need to be on title for $1 million. Whoever's on title for the other $500,000 worth does not matter. As long as I fulfill my own exchange requirements, which is to own $1 million if that is my contribution from a 1031 exchange. Now, ladies and gentlemen, last thing I want to talk about, because we are in tax season, how does Uncle Sam get all this information? How do they know what you sold, what you bought, and how you are structuring everything? Well, once you complete your 1031 exchange, you do have to file the Form 8824. It's a summarized version of your 1031 exchange to let Uncle Sam know, hey, Uncle Sam, I did a 1031 exchange, so I fulfill all the requirements. I'm deferring all my taxes, so you should not expect any tax money from me. And ladies and gentlemen, this is what the form looks like. You can fill it out, your CPA can fill it out, but we, the exchange accommodator, cannot fill out tax forms for you. You will have to do it, or your CPA will have to do it. Well, looks like we do have one more form. Ladies and gentlemen, if your client is buying properties, replacement properties out of state, outside the state of California, they do have to file the Form 3840 every year that they own a property out of state. That is the California clawback. California basically wants to know every year that you own that property out of state. Because you are doing a 1031 exchange, that is essentially like saying to Uncle Sam, to the state of California, I'll pay you in the future if I decide to sell that property in the future and not do a 1031 exchange. But as soon as you sell that property, California is going to say, hey, Wei Ming, are you doing an exchange? If you're not, we're going to need our tax money. So that is what this form is, the California clawback, or Form 3840. Now, ladies and gentlemen, I know that was a lot of information, and it could have gotten a little bit complicated. I went over the information a little quickly as well. So if you do have any questions about the more advanced topics we discuss here today, please let me know. That actually concludes the 1031 exchange portion of this presentation. I'm open to any questions that you may have. Please feel free to unmute yourself or type out in the chat box if you do have questions. All right. It doesn't look like we have any questions at this time. Well, ladies and gentlemen, here is my direct contact information. The best way to reach me is my cell phone. Feel free to text me, feel free to call me, or shoot me an email. Any of the method works, but the easiest way is to reach me by cell. Again, if you do have any questions about any of the information I have included here today, I'm more than happy to go over that with you. Happy to provide you with a copy of the slides. And of course, if you do have more general 1031 exchange information, Kristen and I have set up webinars to go over the more basic concepts on the 1031 exchange. The more sorry about the plane. To go over the concept on the exchange, the requirements, and we can also do a webinar on how to farm using 1031 exchange, what to look for, what type of clients are more likely to sell, things like that. If that's something that you're interested in, please let me know, and I can always talk to Kristen to set that up. Thank you very much, ladies and gentlemen, for attending the 1031 Exchange webinar today. I hope that information was helpful to you, and I hope everybody have a wonderful weekend. Thank you.
Thank you. Thank you, Winnie, for giving our
Yeah, thank you.